Hey there, welcome to the Reinsurance Podcast, the place where we dive into all things reinsurance, the coolest part of insurance. We're your hosts, Jared and Ben, a couple of ex-practitioners who loved the industry so much we founded Supercede to tackle some of its biggest headaches. And we're here to share our insights and stories with expert guests as we uncover what's really going on in the industry.
All right, welcome everybody. If you're just joining, this is the Insurance Institute London 1-1 Renewals Lecture, a regular feature of the calendar. We always get to talk about these similar learning objectives, which are understanding the wider context of the 1st of January 2025 renewals, understanding what actually happened during those renewals and the key drivers of market conditions, supply, demand, etc. And towards the end, we will also come to look at the emerging trends and possible implications for the reinsurance market, including the recent wildfire activity and what that might mean as we look forward. But it won't be me doing the talking. You'll be pleased to hear we have with us Tom Wakefield, who is the Global CEO of Gallagher Re. Tom, welcome. Delighted to have you here. And we'll come into your talk very, very soon. Just a bit of housekeeping before we get started. Everybody is here obviously because they want to hear from Tom, and a side benefit of that is that you also get your CPD points for attending. To get those, all you need to do is fill out the survey at the end of the talk that will be sent to you via email, and then you'll get your CPD certificates after that. Tom has expressed his enthusiasm to take questions today, which is brilliant. So what we'll try and do is run through the sort of key areas in the first 30 minutes or so that there's the maximum amount of time left at the end for those questions. So when we move to Q&A, please do send your questions into the chat, and we will ask them to Tom, and we'll get through as many as we can before we wrap up just before 2 p.m. But with that, I think we'll get started. Welcome, Tom. How are you doing?
Thank you very much. Thanks for having me. I'm excited to be here.
Brilliant. No, excited to have you with us as well, and really excited to dive into 1/1/2025. But before we go into 1/1/2025, I wondered if you could help give us a bit of context on what came before. What was the context to this renewal?
Yeah, sure. So I suppose if we go back to 2023, that would probably be the place to start. I think during 22 and 23, there was material shift in rating on the insurance market, but not so much leading into the 23 renewal on the reinsurance market. And what you ended up with was a situation where reinsurers hadn't met the cost of capital for many years. Attrition losses were high. The cost of capital was actually increasing because of interest rates and in the inflationary environment, and needed to be a reset from a reinsurer perspective because investors were losing faith in their ability to deliver decent returns over time. And so we saw a material shift in deductibles and in pricing, particularly on the cat side, but across many lines of business going into the 2023 renewal. And that was really governed by fear at the time, fear of not having a long-term business model that would be successful, of people losing their jobs if they weren't able to turn it around. And through 2023, we saw the impact of that as we actually continued to have elevated cat losses from an underlying insurance market perspective. Reinsurers have protected themselves by moving deductibles, by changing terms and conditions, and moving higher up the stack. So you then go to sort of the 2024 renewal, so the back end of 2023. And at this point, I think people are getting more comfortable that pricing and deductible levels from a reinsurer point of view are at the right level. But they've only done it for a year. Yeah. And we haven't had any major cat events. And the important thing is to deliver stability of earnings over time. So the renewal in 24 went by in a lot more straightforward fashion, a lot less emotion, but fundamentally it's similar T&Cs to the 2023 renewal. And then you fast forward to what we've just been through now. I think as we get towards the back end of 2024, there's an acceptance from reinsurers that, okay, this restructuring is producing more than acceptable terms over time, but there's also demand from clients, and of course the role that Gallagher Re plays to represent clients, that actually the ROEs that are coming in the high teens, the combined ratios in the low 90s, there is something that needs to come back towards clients here from a pricing and structuring perspective, and that reinsurers are getting the results over time, but those results can't be excessive, and obviously the challenges that still exist in the underlying insurance market need to be shared in part with the reinsurance community. So as we move into the 2025 1/1 renewal, we saw some softening of terms and conditions nothing radical, nothing materially changing back towards 2022. But a recognition from reinsurance partners to clients that, yes, they have changed the deductibles, they have changed the structures, and they are making the returns that they're really looking for. And when you come into the 2025 renewal, the context to set here is there's quite a lot of press about $1 billion of new startup capacity. But actually, once you deduct share buybacks and you deduct dividends, retained earnings alone of existing reinsurance carriers, we estimate to have been about $36 billion in 2024. So that gives you a feel for the amount of additional capital that's available in the industry as we move into 2025.
Brilliant. That's a really helpful intro for us. And I remember listening to your explanation there. Last year's first view report was titled, I think, "What a Difference a Year Makes." So we really saw that change. And actually, just by the way, for those of you listening, we've decided not to do slides today because there is this brilliant first view report by Gallagher Re that shares all of the numbers that you'll need. So please feel free to dive into that afterwards or even whilst you're listening today. And we'll focus a bit more on the qual in this session. But I guess turning to this year's report and this year's renewals, there are a few key events I think that gave us a bit of cause for concern in the run-up to renewals. We had obviously some really big hurricanes in the US. There'd been various bits of loss activity elsewhere during the year. We didn't dare put a title on this lecture as to what the report would say because we didn't really know how it would pan out until right up to the last minute, I guess. We'll come on to what you did title the report in a minute, but how were people feeling as we had these hurricanes flying about in the run-up to this one? What were clients interested in talking about, and what were they worried about?
So I think if you're talking cat specifically, I mean, the challenge with cat risk from a reinsurer and reinsurance perspective is that there's a disproportionate exposure to reinsurer results off a relatively small income base. So in effect, what you have is the propensity for a big hurricane to change the results for a reinsurer one way or the other, or a benign hurricane season to have a really positive impact, even though from a total premium pool point of view, it's actually not as large as some of the casualty premiums that come through on a quota share basis. So clearly, and it's obviously a sensational event when you see a hurricane bearing down on the Gulf of Mexico. The reality of those two hurricanes was that they have not turned out to be of the quantum that people thought. In fact, they're actually lower than the quantum that we thought at the time, which wasn't significant enough to materially change the shape or the dynamic of the market. Yes, there is always what would have been if Milton had gone slightly further north into Tampa. The reality is it didn't. What's interesting since then that we've started to see is as these reserves have started dropping, particularly Milton, it does look at first blush like some of the tort reform that took place in Florida is having an impact around assignment of benefits. Putting a number on that is really difficult to do. But certainly the combination of where the hurricane tracks actually went, combined with at first blush, a view that some of that tort reform is making a difference, has resulted in less impact than it would have done. But I think if you go back to before the hurricane activity took place, Ben, all the talk was on US general casualty anyway, right? And that was something that clearly we were very focused on.
Yeah, I remember at Monte Carlo, everybody talking about casualty, and then quite quickly sort of attention swung elsewhere. Brilliant. Well, maybe this is a good time to sort of steer towards how the renewal itself went. Your report came out right at the beginning of the month. It's titled, I think, Differentiation Rewarded. Maybe you could give us a bit of an intro to why that was the conclusion following this renewals versus those in previous years.
Yeah, so we go back to the original question you asked about macroeconomics and what's been going on in the market. Yes, I think reinsurers acknowledge that pricing has been good, and that there's probably some margin in the business that could come out and still be fair for reinsurers and fair for clients. But the structural changes that were made, we haven't seen tons and tons and tons of shifts in those. We are seeing them selectively where clients have a good story. So we talk about differentiation rewarded. The fact is, for those clients that were able to achieve satisfactory renewals and to continue to drive value in their placements, they had to articulate, with our support, they had to articulate a story about the way they were underwriting the account. The reality is we now have a lot more data, and we use that data more effectively, and we can show information and detail. I'll happily go into it by segment. and we can show information in detail which will differentiate clients. And when we talk about differentiation rewarded, we think of that all as a positive. Similarly, if you decided to track the index and to not attempt to explain what you were doing specifically and how that was impacting either your reserving practices or the way you're thinking about cat risk going forward, or the way you're thinking about managing line size on specialty, or whatever segment it is that you're operating in, you similarly were not rewarded because you weren't differentiating.
Yeah, that makes complete sense. I remember actually doing this lecture a couple of years ago. One of the narratives that came out was the risk of clients being the victims of broad assumptions. If you're just taken as client of type X in region Y with X line of business, then this was what was going to happen to you at renewals, where it sounds like with the help of brokers, clients have been able to make their own story known with all the data that's available as well.
And probably just one thing to add, the underlying performance of those clients, particularly when they're buying pro rata proportional reinsurance, is very different, even within the same product line. So the actual performance that's coming through, the development of claims, the way that claims are being handled, it really does vary by clients, so they shouldn't all be tarred with the same brush.
And did we see many major differences between different lines of business, for example, in terms of how the renewals went? I think we've talked about it as being maybe past the peak in general, and general small amounts of softening. Were there any big exceptions or any areas that maybe performed differently to how we thought they might?
Yeah, so I mean, if you break it down by kind of line of business, you look at property. Property risk is still more challenging than property cat from a rate reduction perspective. And then you look at cat risk, and you see the stuff that catches the headlines. And we've tried to avoid, as Gallagher Re, we've tried to avoid the kind of broad brush. And the reason for that is, if you're trying to catch the headline with a big percentage risk-adjusted reduction, that there's so many different components that go into something being called risk-adjusted. So you start off with, okay, what's happening to the price on the exposure, but the exposure might be up, in which case the premium is up anyway. So that might ameliorate what you're thinking about in terms of what you want to charge in terms of total premium. You've got to make changes to deductible levels factored in to that. You've also got to factor in the fact that when did you buy that layer in the first place? Because if you bought that layer new in 2023 where supply was constrained, then you probably paid an amount for it that reflected the fact that supply was constrained. So pricing on that layer should fall faster than maybe something that you were renewing from the previous year or the previous year before that. So we need to be, and then on top of that, you've got things like hours clauses and other coverage issues to think about, which are almost impossible to reflect in risk-adjusted rate change. So I think when we think about this kind of piece around who got a good deal, who didn't get a good deal, you'll be really, really careful when you're talking in generalities. There are trends for sure, and we all want to talk about those trends because they're easier to contextualize and to make headlines in newspapers and what have you.
Yeah.
But you just have to be really, really careful when you think about them. And we encourage clients to be careful when they think about what they're seeing, because it might be very different depending on the nature of the portfolio.
That makes complete sense into renewals that's been difficult to make sweeping statements about. I guess maybe looking back to the reset we had a couple of years ago, have you seen reinsurers fight to retain some things more than others? We talked about attachment points, we talked about terms. What's been the main thing on reinsurers' minds, do you think?
So if you go into the renewal and you think about the three main areas, on the casualty side, there was a lot of noise in Monte Carlo, and I can talk a bit more about the work that our clients did on their casualty books and the way that they articulated that. I'd be happy to do that, and that plays to that differentiation rewarded piece. On those portfolios, the spread in long-term underlying performance is 60 plus loss ratio points in terms of the best performers to the worst performers. Wow. So there's a big story to tell if you've done it well.
Yeah.
On the property side, again, like more focus on, how much limit are people actually buying, and I think there was definitely more capacity coming into the property space, also through ILS, and ILS was particularly competitive. But on top of that, the inflation catch-up or the increase in limit has started to slow down. So there is still more being bought, but it's now more in the 3 to 4 billion category than the 8 to 10 billion category, which we were seeing kind of 12 months ago. So you've got more supply coming into that market and less increased demand. And on the specialty side, there was very ample supply, but outstanding losses which haven't yet materialized, which concentrates the mind in terms of focus, whether it's Baltimore, whether it's aircraft leasing. And the challenge there is, you can have all the capacity in the world, but it's largely still a lead follow market.
Yeah.
And as a result of that, who are the leaders that are going to step up and play that? And when we talk specialty, to be clear, we're talking about, everyone has a different definition of it. We're talking about a whole raft of lines of business. For us, it would be cyber, aviation, construction, marine and energy, those types of segments. You can also talk about specialty casualty. That's a whole different ball game.
Yeah, no, I can imagine, and again, probably tons of nuance within each of those lines themselves. Did you see amongst the reinsurers, you mentioned the retained earnings, for example, being sort of an opportunity for new capital to enter the market, probably more so than startups or otherwise. Obviously, the ILS piece has tended towards property a bit on the cyber recently as well. How have you seen reinsurers, I guess, allocate that new capacity between the property, casualty, specialty lines? Did they all go for the same thing when they talk to you about growth? We want to grow in property or casualty or specialty. Has it been quite broad or?
There's definitely trends like property and specialty would be the main focus, or property cat specifically and specialty. But different reinsurers approach that in different ways. Some are looking to do it through quota share, where they still see opportunity in the underlying market, and others are sticking to their game plan of writing wherever they want to write in the stack, depending on how their cost of capital versus the opportunities that they see available are. A really good, if we go to casualty, is a really good example, particularly US casualty, where you go back to sort of September time, and it was adverse deterioration on more current years that actually was causing real concern, not because those current years weren't still making good money, but because it was a trend of deteriorating losses versus reserves. You fast forward to today, and the casualty market moved a little bit, but not much in terms of reinsurance pricing, because so much of it's proportional reinsurance. So it relies heavily on what have the insurers actually done with this portfolio. And as we dug into these portfolios and worked with our clients going through kind of renewal season, it became really apparent that the shape of limits deployed had materially changed, deductibles had materially changed, payout patterns were materially changing, and actually investment in claims teams and things, some of the softer factors of how people are handling claims has materially changed. And if you talk to many of the cedants who have got really big, well-established long-term casualty portfolios, they're actually pretty bullish about where the insurance casualty market is and where it continues to go with rate outstripping trend. And effectively, by writing proportional, you are somewhat relying on the fact that the insurers are going to get it. They're going to get right over time, and they do seem to be comfortable that they've had many consecutive quarters of rate rise, and they're now getting into a place that, and that was reflected ultimately in reinsurer appetite, which was not the same as cat and specialty from trying to write more and more and more, but with the right story, with the right client explained in the right way, we were able to get continuity of capacity in that space and place some new programs.
Oh, brilliant stuff. And we talked a bit about proportional there and some of the other products earlier. Dare I mention things like aggregates? Have you started to see some products pop back up, or has there been continued discipline from the reinsurers to push back on maybe some of the products they liked less a couple of years ago?
So there is some change, but again, I want to be careful that we're not trying to catch headlines by saying everyone in the market is doing this or everyone in the market is doing that. We saw some lower deductibles, some introduction of aggregates, more on a structured solutions basis where, multi-year, looking more at capital than they are at earnings. We saw some change to hours clauses to give broader, and the reintroduction of free reinstatements over paid reinstatements. So definitely a bit of give back from reinsurers, but not in a sort of uncontrolled or sort of inverted commas soft market way.
Yeah, no, that makes sense indeed. And I wondered if you could share a bit, given the title Differentiation Rewarded of the report, who was rewarded the most? Not specifically, obviously, but what kind of characteristics or behaviours were the winners amongst the cedants able to articulate? I think you mentioned in the report data, but narrative as well. What made some students stand out where maybe others didn't?
So well prepared.
Yeah.
not taking anything for granted, making sure that the reinsurers had access to leadership, the underwriting community, the reinsurance buyer obviously being critical. That was clearly a very important part of it. I think core partnerships with reinsurers, actually understanding each other's businesses and making sure that there's alignment. And we did see some panels shifting around where there was misalignment between reinsurers and clients. And as long as our job is to make sure we execute on the business, actually we want the client and the reinsurer to be as close a partner as possible, because if that happens, then they're much more likely to understand the ebbs and flows and the results as they go up and down over time. So I would say we saw some shifting from clients to actually bed in with partners that they saw as being here for the long term, not just about the terms and conditions. And actually, price is important, but coverage is, one of those things that isn't as much talked about because it's harder to quantify it or put it on a graph. But coverage is also key. And understanding, if reinsurers are trying to exclude something, why are they excluding it? Does the cedant understand why they're trying to exclude it? And does the reinsurer understand why that might be difficult for the cedant and why that they might need to change the way that they think about that? So that type of dialogue and the ability to engage together actually counts for a lot as you go through a market like this.
Makes complete sense. Would you say that in general we've come to a more partnership-spirited time in the market? Just looking back at a very long soft market beforehand that frayed relationships up to quite a painful reset. I remember some of the adjectives thrown out after that renewal were talking quite seriously about some really damaged relationships as a result of that. Have those relationships broadly recovered? Are people feeling more comfortable about long-term partnership now?
So I think the answer to that is yes, but some caution there. I mean, CAT's the obvious one. You look at underlying insured CAT losses of over $130 billion in 2024, almost no reinsurance recoveries whatsoever. Reinsurers turning in high teen ROEs and low 90s combined ratios, all of which clients accept that reinsurers need to make a return, and it offers capital, balance sheet, and earnings protection for clients, right? But there also needs to be an understanding of what's happening in the direct market, what the impact is on insurers in the direct market, and taking a fair share of both the exposure but also the losses over time. And the question going forward is whether that 2-year benign trend combined with adjusted pricing and deductible levels is something that is 2 years of one-off benign large losses, or whether reinsurers need to start dropping back into some of those working layers.
Yeah, I'm sure the narrative coming from the reinsurers is, if this is the new normal, 100 to 150 billion year loss years, then what does a really bad one look like? And therefore they need to keep some of that capital in reserve. But at
the end of the day, it's our job to create optionality for our clients. So the more supply in the market, the supply-demand dynamics dictate that gives our clients more leverage. And as a result, our job is to bring capacity to market to make sure that we can get the best terms and conditions we can for our clients. That has to be hedged and aligned with long-term continuity, relationships, and all the other things that are important. But we have to create optionality because that drives price and coverage.
Yeah, it makes complete sense. And solvency, I think, from the report as well, is looking pretty good amongst the reinsurers in general right now. Maybe that's a good moment for us to sort of steer a bit towards the forward outlook from here. In particular, given most of these renewal negotiations would have happened without the foresight of the wildfires that are happening right now in California. Do you think that will make people look back on the renewals in a slightly different way? Maybe some reinsurers thinking, "Oh, we should have asked for a bit more," or some clients saying, "Oh, we should have got a bit more coverage."
So, the answer to that has to be no, given the capital, as in don't see a material change in market conditions given the capital position of the market. I think there are some nuances. I mean, every reinsurer on this call is going to have groaned when I said that, and every client's going to say, yeah, I mean, if it's going to be a $20 to $30 billion insured loss, call that 7 to 10 reinsured loss, and just the retained earnings are growing the capital base by over $36 billion, then surely that can't have a material impact on T&Cs. So now, I think there are a few caveats that probably need to just talk about. It's a business. It's a loss that is unlikely to be that well spread. It'll be quite focused on personal lines. And so there will be outsized losses in certain market segments. So to sort of say this isn't going to be a problem for anyone would be naive, because there could be certain areas in certain lines of business or certain contracts that would be more adversely affected, and others will be completely unaffected by the impact of the tragedy that's taking place in California. So that's one piece that will come through disproportionately. It also comes at the very beginning of the year, which kind of focuses the mind and attention. And importantly, it also focuses on things like what the peril could be for a fire following an earthquake in California. So it does start people thinking about, okay, well, we've got these wildfires, the loss is X, Y, Z. It's been very difficult to control them, still ongoing in certain areas. What would happen if we got an earthquake and then fire following an earthquake, and it coincided with those types of conditions? So there's no doubt it will focus the mind, but does it have an economically justifiable impact on the market? No. So I think that's probably, I'm just looking at some of the numbers, that I think some of the things to watch out for with this loss are, whether there will be litigation against the utilities, because that has an impact on whether the California Wildfire Fund can be tapped into, which as at 24 had $14.7 billion of capitalization. So who is ultimately at fault for this has quite a big impact on where the insurance losses flow. So that's just something to walk out for. And then, of course, you've got the California Fair Plan, which included nearly $6 billion of wildfire exposure in the Pacific Palisades fire, and how much reinsurance they've got and the protection they've got for it going forward. So there are different moving parts which will impact where these losses flow. There's no doubt there will be a loss, but is it going to impact the macro environment we're operating in? No.
That's a really important nuance, I think, to draw out, because especially, we see the headlines often grabbed by US events just due to the scale of that market, so the fires, the hurricanes, the Baltimore Bridge, etc. How have you seen renewals outside of the US be impacted by what has happened or hasn't happened in the US through the course of the year?
Yeah, so I mean, obviously the specialty market is more of a London market focus. We've touched on the renewal conditions there. If you take casualty as an example outside of the US, a lot of the concern over international casualty books was the US interests abroad in those casualty books, and they've been re-underwritten and reassessed, so that became more straightforward. It's worth mentioning that there were losses in Europe in the cat space, and risk losses last year, and there was some adverse deterioration of certain losses that had happened the year before. So again, we need to be careful with these broad brush rate changes, because if you were specialised in Eastern Europe, you had a tough time last year, and that had an impact on the renewal. And I'd actually say that probably the more strained renewals were of European cat, because they had some losses or adverse deterioration or no losses, whichever one it was, against a market environment that was becoming a bit more straightforward. But of course, what's the right price for something that's had a loss but the market's getting easier versus something that's clean, is very high up, was priced in 2023 at a higher cost of capital. So actually the strain was tougher on that side of the business than it was on, say, a US or a global account.
That makes complete sense. And I guess that leads nicely onto the question I just had about capital availability in general. Whilst it sounds like whilst supply may be increased, demand not quite as quickly, and there's still a bit more capital than there is demand at the moment, are there any particular areas of the market that would benefit from more supply right now, or broadly are we still in a place where there's plenty of supply for reinsurance around the world?
It's a good question. I mean, at Gallagher Re, we've spent the last 3-5 years building out cyber capacity, for example, and really trying to drive supply into both the ILS and the treaty market and grow that out, and we'll continue to do that. But for the first time in that market, it's not growing at the pace it has done in the past. And that's in part because of what's been a fairly positive performance for the last few years. So the actual rating environment has changed. So sitting here today, I can't put my finger on exactly where capital needs to deploy. We are looking at alternative forms of capital because we continue to feel that they give clients a hedge on duration and capacity type. So when we think about continuity, relationships and everything else, there is a different way to do that, which is multi-year, access alternative forms of capital that aren't necessarily subject to the same market conditions as traditional capital. And that's something that we'll work through. How do our clients get the benefit of their own underwriting? How do they think about third-party capital relationships there? So we're doing a lot of project-related work with clients on that. So there will be other ways of putting capital to bear, but I wouldn't be able to sit here and tell you that there's somewhere that we just cannot get the capacity other than lower level aggregate property cat deals.
If you're listening, it's your chance to get involved. No, brilliant. That's really helpful, Tom. And I'm coming to the end shortly, I think, of our sort of structured questions. So if you are coming up with those questions, please do start submitting them, and we will get to them very soon. Before we do that, I wanted to just talk a little bit about, firstly, one of the really big themes of your report was all around data and granularity and how that comes to bear within a reinsurance placement nowadays and in future. Obviously, big backdrop of AI going on around us, etc. But then also just more generally, what sort of leading indicators we might be looking at as the year matures. Obviously, we started with wildfires. We've been watching interest rates and what they've done and inflation for quite a while. Yep. What's going to be on your radar, I guess, as we come into summer and into, well, even before that, spring and summer renewals, and then 1/1/2026 ultimately?
So I think retentions is interesting. When clients try and work out what to retain, they've got this combination of how confident are we in the underlying book, and we saw that in our North American casualty book, where clients would say, "Listen, if we don't get the terms we need for this to work for us, we are comfortable retaining it. We believe in this portfolio," which is both a positive and a slightly daunting message to be sending to reinsurers. But the backdrop around volatility and making sure that there's consistency of earnings over time still exists, right? So if reinsurance pricing doesn't come off in a satisfactory way that lines up more with the pricing of the underlying market pricing is definitely under pressure on the insurance space, but it's still most people would tell you that their insurance book is still well priced. So if pricing comes off, but it's still a risk that you want to write and you still think it as a good opportunity, and reinsurance pricing stays where it is, that would point towards retaining more risk.
Yeah.
But if you retain more risk, you then increase your earnings volatility. And so that's something that I think every CFO, every CEO, every reinsurance buyer will be grappling with. So I would watch that space carefully. The other one, of course, is acquisition. When you've got spare capital washing around, it's actually much harder to give it back than people say it is, particularly when you've got fixed income funds and things like that sit behind these vehicles. So when that happens and it's harder to grow because there isn't an increase in the underlying demand, then people turn towards acquisition. There are some challenges to that involving reserves, pensions, et cetera, which need to be overcome. So that's one to kind of watch out for as well in terms of how we think about that going forward.
Yeah, absolutely makes sense. I guess we've been a market that's seen growth from all sorts of things, including rate, but not necessarily exposure, and a bit of a mix of those things that can be quite difficult to unpick unless you're paying close attention. Brilliant. With that, I think it'd be a really good time to come on to some of our audience questions. So thank you for sending those in, and please do keep them coming. We've reserved a good chunk of time to go into these. The first one I've got on my menu is what can cedents do to reduce premiums from reinsurers? Very practical, pragmatic question, I guess. What can they do to help themselves looking forwards?
Well, we just talked about retentions. I mean, it's not something that reinsurers or brokers particularly want, but ultimately, if you really back yourself and you think the underlying risk is adequately priced and the reinsurance is not adequately priced, then that's something to look at. I mean, clearly, you can put brokers stroke reinsurers into a more competitive environment, depending on how willing you are to trade off long-term partnership with. I do think the lead follow model is an interesting one. If you look at our portfolio, how strictly that is adhered to really does depend on the line of business and the territory. And it's worked really well in some areas and it's completely ignored in others. We do have contracts or clients who should remain nameless where you think, why did we quote this? Because you've ignored all the quotes and firm ordered it as something totally different anyway. that can be a way of driving down price, but then that becomes a function of holding your nerve and making sure that you're comfortable, you've got the support, and that's where the long-term partnerships and making sure that you've got multiple lines of business with the same reinsurer really matter. And then I think there's a little bit of picking your battles as well. I mean, which contracts are really overpriced, which ones are really need addressing, which ones really don't support the underlying business, and really focus in on those, which means that you can go to your partners and say that you write 5 or 6 contracts for me. Fundamentally, these 4 are not broken. We'll renew them. We'll push hard, but this one really needs some focus and attention. And then you're much more likely to get reinsurers sort of saying, yeah, that's a partnership. We understand what they're trying to do. And of course, the final bit would be use Gallagher Re, because obviously we get the best prices for our clients.
Brilliant. Nice. Sage advice, indeed. Indeed. Cool. My next question on my radar is biggest drivers behind capacity availability this renewal season. What caused capacity to end up where it is? I guess we touched on it a little bit already, but the biggest, if you had to pick something.
It's just the retained earnings and the fact that everyone is reluctant to give to. I mean, you see special dividends occasionally. You see share buybacks. But the reality is that with prices at a level where people are making this sort of money, the immediate response of an investor or a board is to say, well, you should just write more of the thing that's making you all this money, right? So that dynamic exists. I do think it's interesting that new capacities come much more into the ILS space, and that is because it's a way for investors to get money in and out more quickly than on a rated balance sheet where your money can be tied up for many, many years. And that's quite indicative of how investors feel about the industry. So an opportunity, yes. Good pricing levels, yes. Do we want to be stuck in this thing while prices decline for the next 10 years? Maybe not. So that's something to think about as well.
That makes sense, and actually leads nicely into my next question, which is on ILS versus traditional reinsurance in 2025. We've talked a little bit about the investor perspective there. How's it from the client perspective at the moment? How do clients see ILS as an alternative or addition to traditional reinsurance coverage nowadays?
So all of our large clients have an ILS strategy of sorts. A lot of the bonds pricing has dropped significantly. I mean, it's slightly counter-cyclical, or can be, so you can end up with good bond pricing when treaty pricing is going up and vice versa, which is a positive. It can give you multi-year, so you have locked-in capacity for an extended period of time. Does come with a different type of exposure, being the basis risk that bonds can come with, and a cost to putting bonds in place, which is above and beyond the transactional cost of treaty. So all of that kind of needs to be weighed up. I would say most of the so I think the cat bond market is a kind of, for property, is kind of a well-established long term. Obviously, we were instrumental in building the cyber bond market, which is now of a meaningful size. But there is also a ton of opportunity to access third-party capital through a combination of sidecars, alternative vehicles. And then you start to get into the world of, well, it's useful to hedge risk, but actually it's also useful to generate fee income and to put risk on other people's balance sheet, but use your own underwriting expertise. And that's a way that rated balance sheets can get more into that MGA type model without becoming an MGA. And that's definitely something that we'll see coming through in 2025.
Yeah, super interesting. There are so many questions coming in that I'm going to hold back my own questions coming off that. So I'll carry on with audience ones. Leaning into maybe the cyber side of your comment, what key changes did you notice in the 2025 cyber reinsurance renewal market in comparison to previous years?
So 24 was all about cyber war in particular. That had been kind of more stable this year. Reinsurers' positions are clear. Whether clients or we agree with them is a different matter, but they're clear, and clients have made their choice about who to partner with. So that was more straightforward. We saw clients missing their incomes on cyber, but performance still being good. So that's an area where quota share orders were reduced.
Yeah. That
also goes hand in hand with the availability of, and people being more comfortable with excess of loss cyber. So what was a concern over event definition is lessening over time. So you've got a combination of results being good, incomes being down, preference to reduce proportional reinsurance, which means we can go and buy excess of loss reinsurance. Yeah. So more of a shift to non-proportional from proportional. But a pretty kind of stable market overall. What I would say about cyber, certainly how we see it, is it is still a developing market. So we have one consultant for every broker within the cyber team, because we see our ability to support clients actually think through these issues. For example, the piece of work we did with Beazley and Munich Re and then published it for everyone to use from a malware attack, RDS type perspective. That is a big part of developing that market, which we're committed to.
Oh, absolutely, and do look out for that report if you haven't seen it already. Similar question. I don't know. I don't think there's too many of these that are individual lines of business, but we have had a request for any observations in respect of commercial motor renewals in particular.
If you're talking UK commercial motor, it was fascinating because the Ogden rate changed. I believe it was the first week of December. Which effectively is, for anyone who's not a motor expert, is the discount rate associated with future liabilities, which had a material impact on the fact that effectively claims are cheaper than they were, although probably not the right way to say it, but effectively pricing reduced significantly. Now, I would put that in the category of, you could sit on this call and say the average rate reduction was whatever it was, 20 to 30%. I don't think that would be a fair reflection of where the market went. I think the market adjusted itself based on the discounting of future claims. So there was technical government-based reason to do that. What it did do was there was at one point a thought that the Ogden rate wouldn't come out until January. That was creating quite a lot of complexity. And do you extend? Do you backdate? Luckily, it came out in December, and actually we were able to execute. It was late, but we were able to execute on all the renewals.
No, brilliant. Very interesting. I guess, speaking of potential surprises, were there any surprises at this renewal in terms of what reinsurers were focusing on or asking questions about that was maybe different to previous years?
No, I think so we have a view based on all the data I've shared with you that there is still room for reinsurers to differentiate clients more, right? And to provide more competitive terms that line up with the issues that insurers are dealing with on a day-to-day basis. But did reinsurers listen and respond to the feedback they had from clients? They did. So I wouldn't want to sit here and bash reinsurers for an hour. They did. Could they do more? Yeah, we think they could. But there wasn't a particular area where you thought no one's listening, there were some that responded better than others on US general casualty in particular. Very clearly some markets that saw it as an opportunity versus markets that were nervous or markets that were withdrawing. But that was really based on their own personal experience over 10 years. And if you just happen to have backed the wrong horse 8-9 years ago, it can be really painful.
Yeah, that makes sense. I don't want to say speaking of pain, let's hope not. The next question was, how will geopolitics affect the reinsurance market in 2025? Obviously a very complex question, but I'll let you take whatever angle.
So geopolitical uncertainty had a big impact on the political violence and terror market, but also things like the marine market with shipments going in and out of various hotspots. You never quite know what's coming next, but it looks like from the latest news that there is likely to be slightly more stability in the world, or certainly in the short term. We all hope so from a human cost point of view.
Absolutely.
And so in likelihood it will result in a reduced premium base, but possibly more transport and things going in and out of these locations. So one does tend to offset the other. Probably the thing to watch out for more from a geopolitical point of view is the settlement of outstanding claims to do with war in Ukraine, Russia, aircraft leasing exposure, because that will have what people have reserved for versus what they settle for will have quite a big impact on market conditions in those segments.
No, it makes complete sense. No, thanks for sharing the view there. The next question I've got for you is, would you say cedents have become more price-driven in their decision-making since 2023, or do they still value relationships to the same extent?
I think they value relationships, because I think relationships also drive repricing ultimately. It depends on whether you're talking about big programs that need capacity or small programs that can be moved around easily. My experience of insurance clients is that these are sophisticated buyers of insurance. They know the market really well. So actually it becomes about a combination of what's fair and reasonable and what actually allows them to write their underlying book successfully and make money and fulfill their own investor requirements. And if their partners from a reinsurance perspective are prepared to support them in doing that, then there is long-term continuity in the relationships. Where things get fractious is where insurers don't feel that reinsurers really understand what they're actually having to try and deal with, or will take their fair share of the exposure that they have to loss. What you don't tend to find is people shopping around on price just because they want to, right? It tends to be because there's an acute issue that they're trying to deal with in the underlying book.
Makes sense. And I've got another question for you on rates here. Could you give some context as to where the rates are now, sort of post 2025 renewals? And then there's sort of a wider part here. Following that reset in 2023, if we've surrendered some of the gains there, has the actual income level to reinsurers actually changed that much? And just any broader thoughts around the talk of market softening at the moment?
Right, okay, that's a very big question. So have a look at the rating tables in First View. Far be it from me to promote one of my competitors, but if you're looking for a like-for-like index, the Guy Carp Cat Index could also give you... we try and avoid talking about that stuff because it's so nuanced, as we've been talking about for the previous 45 minutes. But there's no way that anything that's been given back is even close to the gains, because the gains were a combination of deductible and price. And while we saw material changes in price, we also saw layers doubling in attachment point during that period. So we're talking about incremental reductions. And when you see a headline that a top layers had a 15-point risk-adjusted reduction, it may well have done. But the average risk-adjusted reduction, because the premium is relatively low, when you see it across the entire program, you're not talking about those size and scales, other than some of the really big placements where a number of larger carriers had reduced cat exposure or had a different strategy, and they were able to drive more value. But we're just nowhere near where we were in 2022. You would have to have deductibles halving, prices coming off 20, 30, 40%.
Yeah, no, that makes complete sense. The next question I've got for you is, I guess, a bit of a pulse check in terms of what types of reinsurance are most prevalent nowadays. So if you look across all of your placements in 2025, what are people buying most of and least of? There's been a request for in descending order if you can do it. But
in descending order. Okay, so contract count wise, excess of loss will still be the biggest part of what we do. Gallagher Re is not a big fact broker. We might look at it in the future, but for now, it's just not in our sweet spot in terms of what we do. The proportional reinsurance is probably growing, actually, because it's strategic. It shares the fortunes. It generates some fee income if it's profitable through a profit commission. And when you look at total premium to the market, proportional reinsurance will actually be higher than excess of loss, because obviously you're passing through 100% of the underlying insurance premium versus a percentage of the premium itself. So, where we have big carrier relationships, a lot of the premium is driven by proportional reinsurance, but a lot of the result, whether it's positive or negative, will be driven by the excess of loss, because those are the contracts that aggregate, and you're getting a fraction of the premium than you do on the underlying pro rata. And then bonds are material in size. We do many of them. We do TWIO, which is one of the largest bonds in the market. But they're in terms of how they sort of fit in, they would still be smaller than the excess of loss and the pro rata book.
Yeah, very interesting. Next question I've got on here, I think we've covered it potentially, unless you know a different version of this acronym. Have you seen reinsurers react, or how have you seen reinsurers react to the PIDR change in their pricing in 1/1, which I'm guessing is the personal injury discount rate or the Ogden rate?
I'm hoping we've answered that. I won't attempt to answer it again.
So we'll say we've covered that one. And then have you seen an increase in any parametric reinsurance solutions, is the next question on here.
So that's an interesting one. So the answer to that is yes. We were very proud to have done the Moroccan bond that triggered with the tragedy in Morocco. The gestation period for these things is long, and they are involving largely the public-private in particular. Yeah. That's a big part of that segment. They're really useful for covering things where you don't have a ton of insured risk to go from, so you can do it based on a parametric trigger instead. However, they also come, because they are long duration, because they are long pipeline, and because governments come and go, it is a little bit subject to the whim of any particular government or a government body. So that can be both rewarding and frustrating. What we've seen with post the Moroccan, which I believe was 18 months ago now, maybe 2 years ago, we saw a massive uptick in inquiries because it triggered. And I think there's always the fear with parametrics that you have a miss factor if it doesn't go in the box. But that did trigger, and the money was in the hands of the people that needed it within days. So that was a real positive.
Brilliant.
We've also seen some parametric for severe convective storm in the US, where treaty buyers can't get low enough on a treaty perspective, but for selected perils and selected areas, you can provide parametric solutions. That's a really interesting area of the business. So yes, it's growing. Is it growing as fast as everyone would like it to or has said it will? No.
Yeah, no, fair enough. I do remember the new parametric magazines coming out and everything at Monte Carlo preemptively, so we'll see whether they can fill their pages by this time next year. Yeah. Brilliant. I've got a question here on the impact broadly of increased broker facilities and how you think this might impact the reinsurance market moving forwards.
I mean, it's a really interesting one, because I think if you go back to, more than 10 years now, when the first brokers were putting those facilities together, it was deemed to be a kind of soft market play and it will never last. And no doubt they had some challenges in the early days. The reality of these facilities today is they give underwriters access to business that they either wouldn't get to previously, or where the individual risk size or quantum or complexity is such that it would take too much underwriting to justify the premium on an individual risk basis.
Yeah.
So a number of our clients either have separate entities writing this type of business, or they'll write it within their existing portfolios because of the fact that it's actually quite a low-cost way of accessing fairly simple, maybe smaller limits, certainly relevant for Gallagher with more of a mid-market type size portfolio. So I think there's a more established and justified rationale for what's being done. How it impacts reinsurance, I mean, obviously the important bit is aggregates. Yeah. So the data reporting on facilities needs to be to a standard whereby you can roll it up. You can be comfortable with what your PMLs are and how you're thinking about particularly cat risk, but it could be risk exposure to a particular area. And that's something that we work really closely with clients on, but certainly not something that's going anywhere anytime soon, and only appears to be growing in quantum.
Brilliant, that's really helpful. Thank you. And then I think last couple of questions probably now towards the end, so last chance before we start to wrap up. Any indications about the H&M marine facultative reinsurance market? I'm going to caveat, I know you said FAC's not as big.
Part of machinery FAC.
Yeah.
I'd love to know what the genesis of that question is. I'm afraid I can't really help you. We do a few bits and pieces, but we're doing our FAC business to really support our treaty clients. We do FAC as Gallagher, but it's done from our direct side of the business.
No, brilliant. Perhaps more familiar, any comments on the retrocession market, please, and whether it's subject to the same or different dynamics to reinsurance?
So retrocession, this is a good question. I should have mentioned it earlier. So on the property retrocession side, prices came off more than on the reinsurance piece. That's not unexpected, because it was a tighter market when it was harder, and it tends to be a softer market when it's softer. There's still, I think retro writers would say there's still good rate and good structures in those markets. What you did see was the traditional markets probably coming off a bit more than some of those that will write collateralized re at a certain price, and they won't deviate from that price, and are happy to pull out of the market when it's not as competitive. So we saw materially bigger rate reductions, double digit, and we also saw an increase in supply materially. Demand didn't increase maybe as much as you would think when you get more competitive retro terms, but it is likely that will be topped up through the year. You don't need to buy all of your retro at the same time. Yeah,
brilliant. I think I might have the honour of a final question, which is exciting. I wanted to ask, just because there was so much talk a while ago about the class of 92, 93, and whether there'd be a white knight saviour reinsurer that would come on when things were tough. How is that window looking now for setting up a new reinsurer? We have seen a couple announced, a couple still in progress, etc. Is now still a good time to be setting up a startup reinsurer, do you think?
I've got to be careful what I say here, because I don't want to be involved in
No,
setting whether or not investors should be making plays into the reinsurance market. That there is no doubt reasons that investors have for having not put tons of new capital into the market. I think something like Oak has a slightly different modus operandi, which they've been able to harvest, and it's good news for the London market that they've got up and running. And I think they've got a good team and they'll do well. I think on the other areas there are bits and pieces coming in. It looks like Merio is launching. And we wish, as I said, our job is to create capacity options for our customers. So from that point of view, it's all good. I think the reason I reference the retained earnings of reinsurers, it just gives you some context in terms of like where the shift or the dynamic exists. And I think there is cry out from clients for capacity where they need it at the lower end and aggregate and what have you. And pricing which is sensibly commensurate to the underlying insurance pricing that they could get. If they need alternatives, it will be because they can't get those two things, and we'll see how the next 12, 24 months plays out.
Brilliant. No, that makes total sense. Thank you again for answering so many varied and difficult questions. I will give you, before I do the final housekeeping exit notes, a chance to just share. Is there anything else you wanted to share with us while we've got you? Any final thoughts to wrap things up on 1/1 Renewals 2025?
Thanks for having me. I mean, it's a very dynamic market. I always look back at the previous 12 months. When we write the first view report, I always try and read the previous one just to refresh on, and it's amazing how much changes in a short period of time. That's what makes our market, whether you're in insurance, reinsurance, broking, underwriting, that's what makes it such an exciting and interesting place to work. And please feel free to reach out if we can help anyone with anything.
Brilliant. Thank you, Tom. You've been an incredible guest, and thank you to our audience as well for tuning in for the whole show. Again, please keep an eye out for Insurance Institute at London lectures. There are tons available. Not all of them have Tom, but there's lots of very good ones that you should still go along to. And of course, we'll be doing this one every year and many other great topics in between. Please do fill out the survey and get your CPD logged afterwards, and we'll see you at another lecture very soon. But for now, that's all from us. Thanks again. Thanks for tuning in to the Reinsurance Podcast. If you enjoyed our show, don't forget to subscribe wherever you get your podcasts and leave us a review to let us know how we're doing, preferably 5 stars. For more insights and updates, follow us on LinkedIn and visit our website at supercede.com/podcasts. You'll find the links in the show notes.